All right, let's talk about Regeneron. They just dropped their Q4 2025 earnings, and on the surface, man, it looked like a home run, but then the stock, it dropped. So what gives? We're going to break down exactly why the market was less than thrilled. Let's dive in. So this is the big puzzle we need to solve today. Regeneron comes out with numbers that blow past what Wall Street expected. I mean, top line, bottom line, a solid beat all around. You'd think that's a perfect setup for the stock to pop, right? But nope, it actually went down. So why? Let's get to the bottom of it.
Okay, first things first, let's just look at the headline numbers themselves. And seriously, by any standard metric, this was a fantastic quarter. They totally smashed the forecasts. So let's start with the bottom line, earnings per share. The street was looking for $10.62. What did Regeneron deliver? $11.44. That's an 82-cent beat. I mean, that's not just squeaking by. That is a clear and solid outperformance.
And you know what? It was the exact same story when you look at revenue. The expectation was $3.8 billion. Regeneron pulled in $3.88 billion. So you've got to beat on earnings, a beat on revenue. The good news part of this story is pretty darn clear.
Okay, and this is a big but. This is where things get a little tricky. See, the market is smart. It's looking past those shiny headline numbers. And what it sees is a company that's kind of like a car with two engines. You've got one engine that's absolutely screaming down the highway, and you've got another one that's sputtering and facing some major headwinds.
And this really lays out that two-engine reality perfectly. Just look at the growth engine. It is on fire. We're talking about Dupixent sales up 32% year over year. EYLEA HD up a massive 66%. But then you look at the other side of the coin. The company's older legacy drug, EYLEA 2 mg, is getting hammered by competition, and its sales are actually falling. That is the real story here, the tension at the heart of the business.
And look, management gets it. They're not blind to this. They called it a solid quarter of commercial execution. And you know what? They're right. They are absolutely crushing it when it comes to their new growth products. That part of the business is doing great.
So that brings us back to the big question. If that growth engine is firing so hot, why did the stock drop? Well, the answer isn't about what just happened. It's about what's going to happen. Investors basically shrugged off the great quarter and zoomed in on one thing: the rising cost of keeping that innovation pipeline fed.
And this is the number that really spooked Wall Street. Check out their guidance for 2026. R&D expenses, we're talking around $6 billion. And SG&A, the cost to sell their drugs and keep the lights on, that's another $2.5 billion plus. Both of those numbers came in hotter than expected. And for an investor, that's simple math. Higher costs tomorrow could mean lower profits down the road.
So here's the real kicker. Regeneron is sitting on a mountain of cash, over $16 billion. So investors are looking at these rising expenses, they're looking at that pile of money, and they're getting a little antsy. They're basically saying, okay, you're spending a ton, now show us the big splashy move. Give us a huge pipeline win or go out and buy something exciting. The arithmetic of the quarter just isn't enough anymore. They want a new story.
And all of this brings us to the market's verdict for the day. And it's a really important lesson. Sometimes a great earnings beat just isn't enough.
So let's just put a pin in this one more time. The operational results? Excellent, a clear beat. But the market's attention? It was completely somewhere else. And that led to the final result for the stock, which was this, down over 1% on the day. And with a lot of shares trading hands too. This is just a textbook example of the market saying, we don't care about what you did last quarter, we're worried about your future spending, and we need to see a new, big reason to get excited.
Okay, so where does that leave us? What should we expect from Regeneron going forward? That brings us to our final segment, the next call. This is our take on what you need to be watching and how we're officially rating the stock. All right, so looking ahead, we've got three major catalysts on our radar. First up, late April, we've got an FDA decision for the EYLEA HD pre-filled syringe. That's a big deal for defending their market share. Second, we're waiting for some key data on their melanoma drug, fianlimab. That could be huge. And third, and honestly, this might be the most important one, we're watching for any hint, any signal at all about what they're going to do with all that cash. Is a big M&A deal coming?
So you have to weigh these two things, right? On one hand, you've got incredible execution on their growth drivers. On the other, you have those competitive headwinds and those rising costs. It's a very balanced picture right now. Which brings us to our official rating.
And that rating is market perform. Now, what does that mean? Basically, we think Regeneron's going to perform pretty much in line with the rest of the healthcare sector. The company's doing a great job, no doubt, but Wall Street knows that. It's already baked into the stock price.
If you want to see this stock really take off again, it needs that new catalyst we've been talking about, a big pipeline success or a smart acquisition to really get investors excited about the next phase of growth.
And of course, we have to say it, this is for informational purposes only. It is not financial advice. Thanks for tuning in.